last month, welcome home. If it's your first time, I think you picked a really, really great one to start with. Today, we're going to be talking about whether or not you're ready to invest. So pull out your pens and your paper, take notes, or use your phone. This is going to be, I think, a short and sweet, maybe 30 to 45-minute session that's packed with a ton of valuable information. So let us get into it. But first, if you have any questions, the chat is open. Feel free to ask questions, and then I'll get to it at the end. And no question is dumb. So I'm going to do something today that most people in my position would never do. And I'm going to tell some of you not to invest. So maybe you're here today or you're listening to this, the recording, or you're streaming live with us. Welcome. I might tell you that maybe it's not the right time for you to invest. And it's not a don't do it, it's a not yet. And I know that that sounds very strange coming from someone who runs a real estate private equity firm, but this is actually what I've learned after building Phoenix Capital and working with hundreds of high income professionals. The people who have the best investment experience, right? Those people who stay calm during the hold period, those people who reinvest, who build real wealth over time, are the people who were financially ready before they even wire their first dollar, right? So those are the people who are calm no matter what, who are like, yes, let's do it again and again, right? And then the people who have the worst experience, I have learned and I have seen from experience, those are the people who are stretched too far. Maybe they invest too fast before they had a solid foundation, a good understanding. They were super anxious. Those are the people that are emailing us every month about their distributions. They can't handle if something bad happens or even a delay because they didn't have any margin, right? So there's a clear contrasting difference between those two types of people. And so today, what I want to do is I want to give you 5 checkpoints, 5 things that I think that need to be true before you place capital in any passive investment, right? So not just with me, but like with anyone, right? And if you could check all 5, then I think you're ready. Or if you're moving towards that, then your readiness scale is increasing. But if you can't, right? If I tell you these things and you're like, okay, I'm not really there, then I'm going to tell you exactly how to get there. But either way, I say you leave this afternoon or morning for my out west folks, but you're going to leave exactly knowing where you stand and what to do about it. And I think, actually, I don't think, I know that that is very powerful. So let me reframe risk for you, because most people think that like investment is risk. And that risk is about like picking the wrong deal, maybe a bad market, bad operator, bad location. And yes, right, all of those are real. But the risk I see more often, the one that actually hurts people, is being in a perfectly good deal, but at the wrong time for you. So I'll give you an example, right? A syndication is a 5-year hold period. And it's a great investment, right? It could be a really good investment. But it turns into a bad investment if you need that capital year 2 because you don't have enough liquidity and you didn't have enough liquidity when you invested in that deal, right? And so a deal that's returning 8% cash on cash is excellent. Like that's a good return. But if you're so financially tight, right, that you're checking the portal every weekend, like you're like, when am I going to get my distribution? And you're more anxious instead of confident, that takes a perfectly good deal and makes it a bad one because it's the wrong time. So timing is not only necessarily about the market, right? Timing is also about you. It's about, your financial education, your financial foundation, right? Your margin, your readiness, all of that takes into account the right timing for you. And so that's what these 5 checkpoints are about. And so I think when you hear them and when you see them, right, take notes, but I think it'll help you, or like mental notes. I think it'll help you understand why they're important. So I say, let's get into it. And the first checkpoint, and before we just talk about that a little bit, I'm going to talk about it. Don't worry, we're going to get to it. Before we get to these checkpoints, I want to kind of level set you on something, because people use the phrase passive investing all the time and it just gets thrown around. But it means different things depending on who's saying it. So I just want to talk you through like different types of passive investing. I want to walk you through the landscape very quickly so that you can see the full picture. So when I say passive investing, right, I'm not only talking about real estate, I'm talking about like a wide gamut. So the first one, when you think about kind of in real estate, right, you think rental property and owning a single family home, or even owning like a small a small multifamily apartment unit and managing it yourself. Now, I will tell you that that is not passive. I don't care what some podcast told you, but if you are screening tenants, if you're handling maintenance calls, if you're managing it with a property manager, you have a second job, and that's not passive. Now, it can be a great investment, absolutely, but I just want to be honest about what's passive and what's not. A lot of my investors come and they said, "Okay, what's the difference between you and a REIT?" Right? A REIT is a real estate investment trust. And the difference is that it is publicly traded. So you buy shares just like you buy stock. It's completely passive. It is truly passive. It is also very liquid, right? But the thing is that the returns tend to mirror the stock market more than like true real estate investing, because like they're traded on the public exchange. So yes, you're getting exposure to real estate, but you're not getting the tax advantages or the uncorrelated returns of private real estate. But it is absolutely passive. It's very liquid, which is good. Now, syndications, which is what we at Phoenix do, and maybe private equity, I'll kind of lump that together. And this is where like you invest like a limited partner in a specific deal or in a fund, and then you have a professional team that will acquire the property, that will manage the property, that will eventually sell that asset, right, whatever it is. And you, as a limited partner, right, this is very passive. You get distributions along the way, and then you get profit share at the end. It's, again, that is truly passive. The downside to this is that your capital is locked for the hold period. And typically the hold period is anywhere from 3 to 7 years. Most deals are around 5, but like you shouldn't be surprised if it extends to 7. So you need to understand that when you think about syndications and passive investing. And then you have like private lending or note investing, and kind of the best way I can explain this one is that like you're essentially being the bank. So you're gonna be lending money that is secured by real estate, right? And it could be relatively passive, but the risk profile is different. And so you have to do your due diligence, you have to do the work, you have to understand what exactly you're getting into. So that's the difference. And then, we talk about like index funds and ETFs. And you guys all know this because maybe you're diversified and some of your money's put into this, but it is passive, it is very liquid, and it's low cost, right? So, but the way I think about this one is like it's excellent for like a long-term growth, because they don't generally produce like meaningful cash flow. So you're not relying on index funds and ETFs for cash flow. I think about them more like, the wait for 30 years, right, before you kind of start seeing something. And so they're not really an income now vehicle, but they're passive, they're liquid, and they're very low cost. And then I talked about this last month, but another way to think about is ownership, but this is more like a passive business ownership. So maybe you own a piece of a business, whether it's maybe a franchise, maybe it's some sort of like digital business, or maybe even an operating company where you are an investor, but you're not managing it, right? So it can truly be a phenomenal investment strategy, but you have to understand the structure. This is where that matters. So again, just like with note lending and private lending, right? You have to understand the structure. You have to do your due diligence, but this could be a great opportunity if you find the right one. And I'm not here to tell you which one is the right one, but my goal is to kind of help you understand the whole menu before you place your order. So you might be thinking one thing and now you're like, wait, oh, I didn't understand that. Now I'm thinking something else. Because I have seen, right? I've talked to a lot of investors, and too many people invest in something that they don't fully understand. They just don't get it. And then they get upset, they get frustrated when the experience when it doesn't match their expectations. This is such a big deal. And so doing the research, getting educated beforehand is so important. Know what you're choosing, know the trade-offs, right? One of them might not be perfect for you, and another one might be perfect for me, right? Depending on what my liquidity is, depending on where my threshold is for the next 5 years versus you. So you really have to understand like what your financial situation is, and then you can decide. And that's the reason why I said in the beginning, maybe this might not be the right time for everyone, and that is okay. Okay, so let's get into the checkpoints. Checkpoint number 1, I call this one your oxygen mask. And on every flight, and I've flown a bunch recently, They tell you that you have to put on your own oxygen mask first, right? And that's the same principle here, right? My question for you is, do you have 6 months of real living expenses? Some people say three, but I think just to be on the safe side, six. And I'm not talking about 6 months of just like your base salary. I'm thinking like, I'm saying 6 months of like what your life actually costs, right? You might need to do a budget, right? This might be you at the first checkpoint, you might say, man, I don't have this, I don't know this, right? And so figure that out. But I really want you to understand, it's not just 6 months of like base salary, it's 6 months of like what your life actually costs. And you want to set that aside in liquid savings. I mean liquid, right? So think maybe like a savings account and money market, but something that you can get access in less than 24 hours without any penalties, without having to sell anything, without really triggering a taxable event, right? That's what I'm asking when I say, do you have 6 months of liquidity? This money is not your investment capital. This money never gets invested, right? I want to say ever. Let it just sit there. And its only job is to make sure that when life happens, right? And life will happen. You don't have to liquidate an investment. You don't have to pull from your retirement account, or you don't have to make a panic financial decision because you didn't have this liquid access to cash. And this is what I think a lot of like high earners do, right? So they see 80,000, 100,000 sitting in their savings account. They're like, this money should be working. Like, why is this money sitting here and not working for me? And yes, they're right, right? Maybe some of it should be, but not all of it. If you invest your safety net, right, then you don't have that safety net anymore. It's gone. And now every investment that you hold, it carries the weight, like that weight of like, oh, this is my emergency plan, but that shouldn't be your investing, right? That should not be the money that you use to invest. You are really essentially gambling with your stability, and you don't want to do that. So if you don't have this yet, it is okay. This is your first priority before anything else that we discussed today, right? Think about this, sit down, figure this out, create a budget. It's not as hard as you think, right? It's just what comes in, what goes out, what do I have left? What do I need to set aside? What does my month look like from a spending standpoint? What do I need if life happens? Work on that, figure that out. If this is the only thing that you take away from here today, I still think that that's wonderful because it's the start to something. Checkpoint number 2. This is the debt filter. So I want to be kind of nuanced here because the like pay off all your debt before you invest, it doesn't work for everyone. That advice is way too simplistic, and we have gotten past that, especially for high earners. It's not binary. It's not have debt or don't have debt. That's not what it is. I want us to think about debt in kind of 3 categories, right? Green light debt is like your low interest, long-term debt that maybe sometimes has some tax advantages. So you think your mortgage, your student loans that are very low interest, that have manageable payments that you're doing, right? That kind of debt, it doesn't disqualify you from investing. In a lot of cases, right, the returns that you earn will outpace the interest that you're paying, and that's very important. So this is almost like green light good debt, right? You have to carry this very strategically, but it's a lot. Almost all of us have this. And then yellow light debt, or like I call it green, yellow, red, right? These are things like car loans, personal loans. These have like moderate interest, right? They aren't emergencies, right? But they sometimes just feel like a drag because you're having to pay it. But if you're carrying a lot of this, right, factor the payments into your freedom number. And we talked about that last month. And be honest with whether or not debt in this category is limiting your ability to invest capital. And then the last one is kind of red light debt. And this is when the easiest thing I can think about is like credit card balances. These are those really, really high interest revolving debt, right? Anything that is above like 10, 12, 15, 18%, right? If you're carrying that, you really should just get rid of that, right? It's just that simple. This one I'm saying, just get rid of it, right? And the reason why is no investment, right? No matter how good the deal is, no investment will consistently outperform like 18 to 24% interest that's working against you. Like no investment will always do that. So it just makes sense to like pay off some of this debt. And I want to even say like paying off some of that is investing, right? Because it's the highest guarantee return that you'll get. So that's kind of how I want you to think about this. But the take home is that like truly, no matter how wonderful a deal is, right, it will not consistently outperform that interest rate that is almost 24%. So get rid of this. I know some of you might be thinking, right, okay, maybe we're healthcare professionals, we're doctors, we don't have credit card debt, but you would be so surprised how many, high earners actually do have this, but they don't talk about it. So if that's you, there's no shame, but let the math be mathing, right? Let the math do the math, right? Clear the red, and then start thinking about deploying capital elsewhere. But I would say that's the first thing that you have to think about. So we talked about liquidity, safety net. We talked about debt. This checkpoint number 3 this is one that I think trips up a lot of ambitious people, because if you are like me and if you are ambitious, you want to move fast. I get it, right? This speaks to me. But I want to ask you 2 questions and just think about it, right? And the 2 questions are, the first one is your income stable and predictable? Now, some people, maybe you're an entrepreneur and this isn't you, but this is maybe for the W-2 earner who's trying to leverage that to build. So this is who I'm talking to when I say answer these questions. So is your income stable and predictable maybe over the next like 12, 18 months? And so if you are in the middle of a job transition, maybe you're negotiating a new contract, maybe you're thinking about becoming a locums physician, maybe your practice is changing, maybe you're starting a new practice, you're starting a new business, right? And that thing hasn't stabilized, you have to be honest about that, right? And I talk to a lot of investors kind of in this scenario, right? Passive investments, especially real estate syndications, they have a hold period, right? Truly, 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 your capital is locked for 3, 5, 7 years sometimes. So you need to know that your income isn't going anywhere while that money is deployed, right? Because you won't get access to that money. So know where you are pulling, know what leverages that you have. So what does income stability look like for the next year, year and a half, 2 years? And then the second question I want to ask you kind of along those lines is, will investing this amount change your lifestyle or your monthly cash flow? If investing 50,000 means that you're going to feel it every single month, if you're going to have to cut corners, if you're going to have to stress about it, right, then the investment is too much for you. And I'm saying this as someone we always talk about investors and we want investors, but if it's not right for you, it's just not right for you. And you have to be educated and you have to understand before you make the right decision. And so the right investment amount is the amount that you deploy, and then you go live your life, right? So you check the statements quarterly because you want to get educated, not because you're anxious, because you want to be like, okay, what's going on? I want to learn about my investment. Like, you sleep the same, your spending doesn't change. That is the amount that you have to be thinking about investing. Are you comfortable with that, right? Does it not change? If you are tossing and turning the day after you invest money, right, then maybe that investment was too much. Maybe you did it for the wrong reasons. Maybe you didn't go through all these checkpoints to really think if it's the right investment. So those 2 questions I asked, right? Will the investing change your lifestyle? And what is your runway from an income standpoint over the next 12 to 24 months? If you answered no, you're not necessarily behind, right? You're just not at this checkpoint yet. So your job is to go get your income stable. Right size that amount, whatever it is for you, but right size it and then move. So figure out, get the stability, right? Go through the contract negotiation, get your practice stable, right? Do those things and then start investing. To some degree, towards the end, you can do both of those simultaneously, but only you truly knows like where you are from a financial standpoint and your financial readiness. Okay, so let's move on to checkpoint number 4. This is tax clarity. I am passionate about this one because this is where a lot of high earners lose the most money, right? And they do it without realizing it. And this is not going to turn into a tax lecture, but this is what I need you to know before you make an investment, right? Do you actually know what your marginal tax rate is? So not roughly, but like, do you actually know it? Do you know what you're paying in taxes, like when you add federal, state, if you have self-employment tax, like if that's applicable to you, right? Do you know what that is? A lot of people are earning 300, 400, 500, but they haven't really actually calculated that effective rate. And when you do, it might be very painful. So you might as well just do it now so you know. But the reason why I ask you that is because then the next question is like, are you maximizing a lot of tax advantage accounts that are accessible to you? So 401k, HSA, backdoor Roth, right? All of these things are things that maybe are accessible to you. They aren't exciting, right? They're not fun, but they are guaranteed tax savings. And sometimes you just need that. And if you aren't maximizing some of these, right? And maybe you're investing in alternatives, right? You might be leaving easy money on the table, right? How the idea is always like, how am I decreasing my tax burden? And then another one is, so I talked to you about those things. And but also, do you understand, like in the investments that you do, and this is something I talk to a lot of my investors about, right? Do you understand the investing, how that investment will be taxed? So I'll give you, for instance, right, syndication income. It's sheltered by depreciation. And I talk about this very often. This is one of the major advantages of investing in real estate, right? But if you don't understand how the K1s work, if you don't understand passive losses, how those passive losses are offsetting your passive income, if you don't understand, like, to just a basic knowledge of like cost segregation, how that benefits you as a passive investor, then yes, you made a decision and it might benefit you, but you're not making it with full information. And so my kind of advice is that if you cannot answer these questions clearly, get someone. And when you become a high income earner, right? And you might be there, you might be getting there, right? You need more than just a general CPA. You need more than someone who's just going to file your taxes. Look into getting just a simple tax strategist, but think about having a conversation with them before you invest, right? This is someone who is like maybe helping, like really proactive about helping you keep more of what you earn. Because at the end of the day, that is exactly what we want to do. We work so hard, right? And a lot of it just goes away. The idea is, how can I keep more of what I earn? And that conversation really is more fruitful, more beneficial when you have that with a tax strategist. And that conversation will pay, like, it will pay for itself multiple times over if you find the right person, and you have the right conversation. I think the first month that we started doing the monthly webinar, one of the things I asked is, who's keeping you accountable? And this is one of the people. So we talked about taxes, we talked about debt, we talked about liquidity, we talked about income, and this is the last checkpoint, right? This is the one that protects you from everything. So bad deals, bad operators, bad timing, all of it. And this one is not difficult, is, can you explain this investment to someone else, right? Not jargon, but just in plain English. Like if your BFF or your spouse or, like your parent asked you, what did you invest in? Can you clearly explain what the asset is, how it generates returns, what the risks are, when you get capital back, who's managing it, right? These questions right now, they might seem foreign to you, but these are questions that you should understand, even as a passive investor, right? Just because you're passive doesn't mean that you close your eyes and just let someone else completely take over anything that has to do with money for you, right? If you cannot explain these, right, maybe you're not ready to invest. But that doesn't mean that you can't get this within the next month, right? And it's not an insult. It just means that you're ready to learn. And by you being here or you listening to this, right, that means that you're ready to learn. And there's a very big, massive difference between the two. The most dangerous investor is the person who just writes a check based on like someone else's enthusiasm, right? Maybe you're an investor circle, you're an investor group, and someone brings a deal and you're just like, oh, this sounds good. And you just do it, right? That is a dangerous investor. Or you heard a podcast and you heard someone really excited and they gingered you and you're like, okay, I want to do. Or like you're at work, right? And you overhear someone saying, hey, I found this great offer, like we're all doing it. So you have FOMO and you're like, I want to do it too, right? That is dangerous. And the returns can sound really good, right? And so you invest, but you can't explain it. And that's how people really get hurt, right? I will say for, every single investor who invests with Phoenix, right, we have a one-on-one call. And I noticed that the best investors, they ask the sharpest questions, right? They're the ones who read the deck and they understand the business plan. And so they come ready to, and they ask me questions. And I'm like, I pause because I'm like, oh, these are really good questions. Like, like you brought your A game, I'm bringing my A game, but like they understand the market. They're asking, well, why are you in the Southeast, right? They're asking, what type of market analysis do you guys do? They understand, when you tell them that this is risk-free, they chuckle. Well, we won't ever say that, but like they can articulate like their concerns, their risk. And because they know, like you can tell that they did the work up front, right? They're calm during the whole period. These are the people who, who like I will have quarterly investor calls and they don't show up because they knew what they were getting into. They understand. They're continuously getting educated, right? They trust the process, but they trust the process because they understood it before they entered, because they asked the questions before, and so they feel comfortable. If you have not done your homework yet, right? This is the month to do the homework, right? Pick one asset class, right? Go deep. So that means read, listen, attend webinars, ask questions, schedule a one-on-one call, but get to the point where you don't have to be an expert, right? But you can teach some of it back. Like when someone says, hey, what deal are you in? You can say, oh, I'm in this, and I'm doing this, right? And that is when I know that you are ready. And so we've passed kind of the 5 checkpoints, right? I hope that you were taking notes, but now you understand, maybe you've done research or you're going to do research and you know an asset class, right? I want to just give you some questions, right, that you can ask before you invest. So this is part of getting educated. Take a screenshot, save this on your phone. If you go into your next maybe potential investor call and ask some of these questions, I want you to ask all of them. But if you ask these questions, right, you will be armed with so much knowledge, right? You will be able to make an educated decision, and you will be able to take risk, but that risk will be calculated because you have the knowledge. So the first one, question number 1 is, if you're investing with an operator, right? What is their track record? Like what deals have they completed? Not just like stuff they started, not projections, but like how many deals have they taken full cycle? And if they haven't, have they partnered with others who have, right? What are the actual returns versus like what they projected? Anyone can show you beautiful numbers, right? You can just push a few levers and you can get like 20% IRR. I want you to kind of look beyond the pro forma, show result. The second one, this is important, right? How much of your own money is in the deal? This is a question that you're asking to the operator. And simple, this is skin in the game. If an operator is not investing alongside you, you have to ask why, right? And it's not an automatic disqualifier, but it's a conversation that's worth having. Like, why aren't they? Maybe they've been investing in the last 10 deals and they're tapped out of like liquid capital, and maybe that's a reason. But have that conversation, ask. And the third one is like the fee structure. So you get acquisition fee, you get management fees, you get disposition fee. There might be a promote structure, right? So how is that person, how's that team, how's the operator getting paid? And this is not, you're not asking this question because you're saying, oh, the fees are too low, right? They're probably industry standard, but the fees have to be transparent, right? Know exactly where every dollar in a deal that you are investing is going into. The fourth one, what happens if things don't go as planned, right? This question, people are afraid to ask this question because like when they invest, they want to hope for the best, right? But you should ask, right? And a lot of people don't ask. Like, what happens if the interest rate market changes? What happens if it's a real estate deal, what happens if occupancy gets too low, right? A good operator will have thought about the downsides and would have accounted for them, right? Would have had contingency plans. Maybe they have a 10% contingency plan or 20% contingency plan that they raise for, right? So they have that money. They have that money sitting somewhere, maybe in escrow or somewhere, just in case, right? If somebody only talks to you about all the upsides and how great the deal is, you should be cautious, especially after listening to me. And number 5, right, is like, what is the preferred return? Is it cumulative? And some people don't know what a preferred return is, but it's the return that you receive before the operator gets any sort of profit. So that is your entitled money first before we get paid, before any other operator gets paid. So you need to know what that number is. and also know whether it accumulates. Like, so if the deal is not doing well, let's say year one, there's a ton of renovations, right? And maybe you didn't get all your preferred return. Is that going to accumulate over time till the end? Like, will you always be guaranteed that 6% or 7 or 8%? Those are questions you should ask. And the next one is like, how do you get communicated to? So is it monthly updates? Is it quarterly reports? Do I have to go into the investor portal? Because you're locking up your capital for years, right? In whatever you're doing. So you deserve to know how the deal is performing. You deserve to be talked to, right? Whether it's virtual, whether it's a meeting, whether it's show up at the deal once a year, whatever it is, right? But just know what that specific operator, what that deal looks like. And then number 7 is tax implications, right? When am I getting a K1? What does it look like? What are the depreciation benefits? Would there be a tax liability at sale, right? Am I going to pay capital gains tax? Make sure, and this question, right, kind of tax into checkpoint 4, which we're talking about taxes, but understand these. That's another question that you should ask. The next question, number 8, is like, what is the realistic hold period? And what happened? Like, could that be extended? So like, if they say 5 years, right? Could it be 6? Could it be 7? How will market conditions affect it, right? Like, will you ever have to refinance, right? You have to be comfortable with the longest realistic scenario. But if you don't ask, you're not going to know. And number 9, I think this is the one that like separates good operators from great ones. But like, you have to ask, right? Have you lost investor capital? And if the answer is yes, what happened? I'm learning that if you do business for long enough, right, you are going to deal with some sort of adversity. But what matters is not that it's going to come, because it'll probably come, is how you handled it. And so transparency is everything, right? You tell your investors the good, the bad, the ugly. You let them know. You let them know what you're doing about it. You let them know your thought process. You let them know plan A, plan B, plan C. You let them know contingency plans. I think that gives investors peace of mind, satisfaction. It's not that we hope, that something doesn't go wrong, but if it does, what are you going to do about it? And the last one is, can I speak with investors from prior deals? And a lot of my investors ask me this. If the answer is no, you should just say thank you, but no thank you, right? Because you want to know. And if they say yes, then take them up on the offer. Like, have a quick call or text chat with a prior investor. Call them, ask for questions, ask them about transparency, about communication, about the returns. How was it? Like that. Somebody who is already in a deal, right, is your best due diligence, right? Because they'll tell you. Some of them will be like, man, this deal sucks. Like, this group sucks. Don't join them, right? You have your answer, right? But you should have access to these people. And kind of, this is the final point on this slide, right? If an operator is defensive about any of these questions, then you have your answer, right? The best operators are not perfect, but they're open to like these questions. They welcome it. And if someone makes you feel bad, for doing your homework, for doing your due diligence, then they're not the right partner for you. And so this is a quick scorecard, right? Check things off right now. Be honest with yourself. Nobody's going to see your score but you. I'm not even going to ask you to put it in the chat. If you really felt comfortable with these 5 checkpoints, then you're ready, right? The next investment opportunity, study it, read the deck, ask questions. Maybe it's the right time for you to jump in, right? You have the foundation, you have the clarity, you have the knowledge to really start kind of evaluating these deals. And that is a powerful place to be. Now, if you are like, okay, these checkpoints, I'm at 3 or 4, you're close, right? You just need a few, you just need a few things. You need to do a few things to just get you there. And so maybe it's like your emergency fund, or maybe it's having that tax conversation, right? Who are the people that you surround yourself with as you grow from a financial standpoint, as you become financially ready, right? So maybe take the next month. We always do this at the end of the month, kind of to get you into the next month, but take that and get educated, set up a call with maybe 1, 2, or 3 people that you can evaluate, right? But close the gap. It's not going to take long and you will be ready. If you're just like, okay, I'm at 1 or 2, right? Then you're building the foundation. And I want you to hear this very, 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 very clearly. You're not behind, right? it's smart. You decided to come here this Saturday afternoon to learn. And the person who builds the foundation first will outperform the person who skipped and who just like invested because they they didn't want to have FOMO, right? The right opportunity will come. There are opportunities every single day. But when the right one comes, right, it'll be right for you because you're going to move with confidence instead of just like anxiety because everybody's passing you. So no matter what you scored, it just helps you to know exactly where you are today. And that's the whole point of this conversation that we're having. And so before we move to Q&A, I want to share three mistakes that I see the most. And I'll also be honest, I made some of them very early on in my journey. The first one, which was talked about, is investing with the emergency fund. Now, it sounds like, oh, why would you do that, right? But sometimes you see a deal and the returns are strong. The operator, you're like, oh, these people have done well. And you think, oh, I'm just going to rebuild my savings later, right? And then something happens and you're going to be over leveraged emotionally, financially, very stressed. And so that good investment, right, now becomes a bad one because because you did the wrong thing, right? So just before you do that, I would say just pause a little bit. The second mistake is chasing returns without understanding the structure, right? Sometimes you want to compare deals apples to apples, right? So sometimes you might hear, oh, 22% IRR, and you're like, oh, of course, like why wouldn't anyone invest when that's the return that's being projected? But maybe you didn't ask, like, what's the waterfall? What are the fees? What happens if the whole period extends, right? Was that a very aggressive assumption that you made to get to that 22%, right? All of those things, if you don't know the terms, right, then you're just making a big mistake. So learn before you commit, even if the numbers sound too good. And I tell my investors, if it sounds too good to be true, it probably is just too good to be true. And the third one is like skipping that tax strategy. I talk to investors every day who have made great returns and then they gave back like a third of the money because they didn't plan for tax implications, capital gains tax, making sure you have depreciation to offset some of those losses. Is there an opportunity to move that capital into a like deal so that you avoid paying these taxes, right? The more you know, right, the more you're able to avoid some of these mistakes. So at the end of the day, right, I'm telling you these so that you can get it right. When the deal comes. So now I've talked about kind of being ready, and I talked about some of the questions you should ask. I want to talk about why you should walk away. Protecting your capital is more important than deploying it. And even though I'm like, let's invest, let's diversify, sometimes the answer is no. If anyone says this is guaranteed, right, your preferred return, if they use that term, just know that it isn't, because nothing in investing is guaranteed. Real estate is not guaranteed. The stock market is not guaranteed. Treasuries, even though they are the safest, right, they still carry risk. So if anyone is saying you're going to be guaranteed that, you should just question it, right? Especially if you don't fully understand it. And if there's any sort of pressure to commit, like, if there's like the deal is almost full, if it is, it is. And if you're not ready, you're not ready. But if they're like, you have to do it now or you don't get in, you're going to miss out. Some of these are just high pressure tactics. And a good operator would rather you invest with confidence than you invest under pressure. Because if you invest under pressure, right, I will pay for it. And so it's better for you to be confident. So again, right, some of the things that you should just pause and maybe just walk away. There should be third-party verifications. This one is really important. So like, who is the attorney? What's the escrow account that money is going into? What is the structure, right? Money should always flow through the proper legal channels. And if that process feels a little too informal, like you're investing your hard-earned cash, right? And so if it's not structured, or if the structure is very loose, you should just be very careful. I talked to you again about about an operator having capital in the deal. It's very important because if they do, then they are it's your kind of your beliefs are aligned, right? And there might be a legitimate reason why they're not they don't have capital, but you deserve to know. And so that's a question you should ask. If that's the reason why you walk away from the deal, that is okay. If if you ask any of these questions, I said it before, right? If you ask any of these questions and you don't get the answer, or you feel like they're getting frustrated with your due diligence, right? You can call 10 times, right? It's, again, it's your hard-earned money. You get to make that decision. If there's a deal that has a ton of upside and no risk, like, you should ask. If that happens, then they're just selling you something and really not educating you. Every deal has risks. So talk about it, ask questions around it. And the last one I would just say is trust your gut. Like that thing inside of you, like, you show up to these webinars, you're reading books and you're learning, right? And so you're smart people, and you didn't get where you are with completely ignoring your instincts. So if you feel something's off, don't ignore that, right? Pause, ask questions, and then make a decision from that. There will always be another deal. There will always be another. We put in an offer last week. We put in an offer, and at the end of the week, there will always be deals, right? So you might miss out on a deal, but you don't want to lose your $50,000 or $100,000. I think that's very important. And so as we wrap up, I want to share something personal. When I first learned about syndications, I was really excited and I wanted in immediately, but I wasn't ready. I didn't know anything about it. And I didn't have all the checkpoints in place, right? I didn't really fully understand taxes. I didn't ask all the questions. I didn't understand it. And so I had needed to address some debt. I needed more education, right? And then the biggest thing for me, I think, was understanding the structure. And I just didn't want to get excited about it. So I waited, right? I learned, I got ready, and then I invested. And I think for me, that was so big because I wasn't anxious. I was very clear, right? The deals performed really well, but I didn't have to worry. I just knew that every quarter I was getting a check in the mail. I was not a check in the mail. I was getting a check into my account, right? But I didn't have to worry because I truly had some of these checkpoints. I passed on a few deals before the right one came. And so the next deal might not be from you, right? Might not be for you, and that's okay. That patience at the start is why, like, I'm standing here today as a firm owner, right? I didn't invest recklessly, and I didn't invest recklessly and just get lucky, right? I built a foundation. I asked the questions. I read the books, right? I showed up to webinars. I showed up to deal webinars. I went to tour the property, like all of that stuff. So I didn't rush into it. Instead, I was moving with clarity, with confidence and readiness. At some point, right, I had to make the leap. I had to decide and say yes. And at that point, right, I felt confident that I had done my research. I understood if the deal went bad, it was just because some deals go bad. But I felt very confident in the questions I had asked, in everything I had studied. I did interview investors, like investors in prior deals, because I just wanted to know what it was like, what the experience was like. So a lot of the things I'm telling you today, I actually did them, and it resulted in success for me. And so this is a slide I wish someone had shown me before my first investment, because nobody talks about what actually happens like after you wire the money. So I just want to talk to you after you invest, right? After you're ready, your 5 checkpoints. I want to talk to you just a little bit about, walk you through it. In the first few months, right, you're going to invest, you go through the onboarding, you sign the legal documents, the subscription agreements, you're going to read through the operating agreement, you have access to the investor portal, you see the investment, the documents, distribution, you see the accounts, right? All of that, you get that. Nothing's going to happen for a while after that. You're going to start getting updates, right? So, and then moving forward, right, just depending, you might get monthly updates or quarterly updates, just depending on the deal. We do monthly updates at Phoenix, but this should tell you kind of how the deal is performing. If it's real estate, like what's happening to occupancy, renovations, you should receive distributions on like whatever schedule that was outlined in the subscription documents that you received. So it could be monthly, it could be quarterly. Very few are biannually, but it's just depending on what the operator and the deal calls for. And then some will have like preferred returns that are going to accrue, and then maybe they'll pay at sale or at refinance. So just make sure you understand all of that. And then during that whole period, now the whole period can be 3, it can be 5, it can be 7 years, right? The operator is going to be executing on the business plan. So that means like they're managing the deal, they're implementing everything that they said. And so your job during that period is just to stay informed. Read the updates, be patient. And the thing is, like, you're not managing it, which is a good thing because that's what you wanted to do. And then at the end, so I kind of breezed through 5 years, but at the end, there'll be a capital event that is either sale, and that's when you get like all of your profit, or there's refinance, right? Where you might get a return of a portion of your capital, and then you stay in the deal for like an additional 2-3 years. But that's kind of what the ending will look like. And that's it. That's like the life cycle of the whole of the deal. So when you understand it up front, right? The whole period doesn't feel like you're waiting. It just feels like, okay, I know I felt good about this. My checkpoints are in place. I have residual income and I'm willing to put it in. And then you just kind of watch and see everything unfold. Okay, so we're wrapping up. This is your homework. And unlike school, this one will actually pay you back if you do it well. So I told you, score yourself. Remember those 5 checkpoints, write it down somewhere, see it again, watch the replay. And then, so that's the first one. And then for every checkpoint that you didn't pass, write down one specific action that you want to take. Right. So like whether it's open a high yield savings account, or set up a meeting with a tax strategist, or read one book on passive investing and learn different types of passive investing. Make it specific, make it concrete, but do it. Right. And then put an action to it. So I always write like, okay, I need to do this. And I put a time. So like in the next 2 weeks or before the end of the month, right? If you have like an action without a deadline, it's just a goal. It just becomes like a wish. You're like, okay, I wish at some point I'll get this done. So I would say give yourself some leeway. Try to do these things by next month's session. And if you do that, you'll be in you'll be a fundamentally different person, and you'll be in a different position than you are this morning, this afternoon, depending on where you are. But that's the power of getting educated. That's the power of building a framework. And that's really what we do in this community. Our team is going to put up a link, and that's just to the Phoenix Resource Center. It's just easy access to get free educational material to continue learning, to help you grow on this journey. And so I want to leave you with this. The best investors I know, they aren't the ones that moved first, but they're the ones who moved when they were prepared, when they were clear, when they had clarity, when they were confident. And that is the energy that I want you to carry into your next investment. It requires some work from you. It requires preparedness. But if you do that and you move into your next investment with that, you will not regret it. And so that is what I want to leave you here with. I want to say thank you for being here on a Saturday afternoon. Go do the homework. Let's just keep building. I think for some of you, this is the start and this is the foundation that you're building. For some of you, you listen to this and you're like, okay, I'm pretty sure I'm there, or I'm almost ready to start investing, to start building wealth, right? So wherever you are, know that it is okay and you can only grow from there. So I'm going to say thank you. And if you have any questions, let's open it up for some questions. If you are like, okay, I want to work on a checkpoint, ask me, is there anything that stood out to you? Drop it in the chat. But the fact that you showed up here to a webinar called Am I Ready to Invest just tells me that you're the kind of person that you want to do things right, you want to grow, you want to learn, you want to be educated. So if there's anything that you have questions about, please feel free to put it in the chat. But hoping to see you next month. Thank you for your time. And I will open the chat up for some questions. Okay. So I think this is very clear and there are no additional questions. Oh, someone is typing. If you have any questions, please feel free to put it in the chat. I'll wait for another minute or two. But if there are no questions, I'll give you back some of your Saturday. Okay. Maybe they stopped. Oh, thank you. You're very, very welcome. I'm glad that this was informative. Oh, I got a question. How did you find your first deal? Very, very good question. So when I was ready to start investing, I got connected. So I joined groups online. So I joined investor groups on. Okay, perfect. Thanks for putting it up. But I joined investor groups online, Facebook groups. Joined, kind of just asked around, what are people doing? When I went to conferences, if there were any kind of financial information, I would join it. I would listen to it. I signed up for, anything online that was accessible to me in terms of real estate. I knew I wanted to get into real estate. I started kind of looking into that, and I started asking questions and started to figure out what people were doing. So that was kind of how I started. And I will say that in the beginning, there was a significant amount of due diligence on my part, just because, again, I was making a decision to invest a significant amount of capital. And so I wanted to make sure, to the best of my ability, that it was the right decision. And I passed on a few, but when I decided, I felt, okay, this seemed like the right deal for me, and then I jumped into it. But as you start, right, just like how you're in the Phoenix community, when deals come, when we have access to new deals, right, go ahead, take the time, do your due diligence, learn about the deal, ask questions, schedule a call with someone from our team. But I think you being here means that maybe you are ready and you're asking the right questions, and then you're opening yourself up to different ways to find the deal. But a lot of groups online have access to, like, at least just have like-minded people, high net worth investors who are looking for the right opportunity. So just be careful with everything, right? People are always kind of going to sell, but use this, truly, some of the things that we talked about this afternoon, use them to help make better decisions. For someone who wants to start investing this year, what specific financial indicators would tell you that you're truly ready? What indicators would tell you you should wait and strengthen your financial foundation first? Okay. So it's a lot of the things I went through today, right? So are you liquid, right? Or do you have 6 months liquidity? What does debt look like for you, right? If you have all these red light debts, kind of pay some of that off first. That's investing. If you have, if you have done your research and asked the questions, ask the right questions, right, and you feel ready, I think those are some of, like, the ways. But the biggest thing, I think, is just where is your liquidity status? And also, like, another financial indicator is the low hanging fruits. Like, are you taking advantage of, like, the tax advantage strategies that we mentioned in the presentation? That's another financial indicator to just say you're truly ready. If you invest, right, if you're ready to invest, and this capital is really going to change your lifestyle, then maybe you're not ready yet. So I would say those are some of the financial indicators to know whether or not you're ready. How did you get other doctors in your deal? You just have conversations. So, I became active online in a lot of these groups. I started building a community. So one of the things was starting to educate. I would say the first thing to do is to get educated. And the next thing to do is find a way to give value to others. So if there's something that someone is struggling with, or a pain point, right, address that. What you want to do is help others, give value, but then build confidence and trust in what you're doing. So I would say that that's kind of how I started. So I reached out to immediate community, immediate circle, shared what I was doing, answered questions, any questions that they had. I did. So when you're trying to bring others into a deal, you need to do your significant due diligence, because sometimes people are trusting you over the deal. And so you don't want to bring people into a bad deal. You don't want to misuse their trust. So I would say those are some of the things that I did that brought success. These are great questions. Um, thank you for sticking around and asking them. Okay. Well, if those are all the questions, everyone have a wonderful rest of your afternoon. Goodbye. Ooh, oh, there's one more question. Okay. There's one more question. How would you handle it if a syndicator hasn't provided the K1s until August, September every year since 2022? Okay, this is a good question. Um, this is a really good question. So you have to find out why, right? Sometimes, if there's a reason why, so I'll give you maybe one reason why. If maybe they're auditing the a deal, right? And so maybe they can't release the K1s. But if it's a habit, then you need to ask the operators why. We had one deal that the K1s we released late, but for us late was third week in March. The others we released it end of February, right? So I tell my investors the process of getting these K1s are pretty. It's a lot of work for the our accountant, the CPA team that we work with. So I tell my investors, right, they will not probably file early, right? They will not file in January. But I will make sure that if they don't want to file late, they will not file late. And so they will make that April 15th deadline. So I think it's going to have to be a question that you ask the operators and you try to understand why, but they really should have it before tax deadline. Good question. Okay, I'll just hang around a little bit, maybe a minute or two. You're welcome. I hope that was helpful. And I'm sorry that you're in that situation. But I'm going to hang around a little bit. And then if there are any additional questions, please feel free to ask. But thank you so much for these questions. They're really, really good. And I know that others are learning from them. Wonderful. Have a great weekend, you too. Okay, I think all the questions are done. Bye, everyone.